Good morning, good morning. How is everyone doing? Oh, wait, let me say that again. Good morning, everybody. How's everyone doing? I'm in a good mood because I lost sleep last night being excited to find out what my test results are. So the line at the T is somewhat faded now. And it's day 6 since I was tested positive. Very excited. So, welcome to the next Building Cash Flow Live. And I hope you're excited because we saw the market swinging upwards over the last Thursday and Friday, right? So, is it a rally? That's what we are finding out today. Just note, this is not financial advice. It's a conversation I have with myself every day. And I like to share this with you. And if you're having these conversations yourself, please come forward because a community is always welcome to have these conversations. Because I can't assume that I know everything, right? So, yeah, last night's trading, what did well? Energy, the sectors that did well: energy, industrial, consumer, discretionary, utilities. Very related sectors to what's going on, unfortunately, between Russia and Ukraine. With the war going on, usually wars uh, have a demand or increase the consumption of especially energy when it comes to Brent oil and industrial. Definitely, there's a materials as well. Um, Although materials didn't do so well last night. We saw rate in the Dow, S&P 500, Nasdaq. Because Nasdaq is mostly got to do with industrials and consumer discretionaries, right? Did slightly better. And again, today's conversation is to find out if it's a rally and if the swing towards the upside will sustain, right? So looking at the indicators, my favorite one that I always go to, the volatility index, and it is still at 30 points. I'm very energetic right now. um, and yeah, it's still at 30 points, nowhere going close to 20. Usually when it stays above 30, it's very difficult for us to see the market having higher highs. And what do I mean by that? Is let's look at the S&P 500, right, as a gauge. Yeah, so as long as the volatility index had stayed, since it stayed above 20, hovering between 27 to 30, right? There's no higher highs since December 2021. So, yet there was a swing towards the upside last week. Will it sustain? So that's where let's look at some of the other indicators as well. For example, the bull bear ratio, the volume of bear investors is still way higher than bullish investors at a ratio of 0.44. Of course, that means it could mean that the sentiment might be swinging towards the bullish side. And the other indicator that I use would be the put call ratio, where if we see a red line here, it means that the volume of call options in the market is higher than the volume of put options. And it's not updated for last night's trading yet, from last night's trading, though the most recent update indicates that there are more call options. So when there's an increase of call options and its volume is more than the put options in the market, it's also an indicator that investors are expecting the market to swing towards the upside. Now, other than these sentiments, right, if we just think about it, what's there to support the confidence that the market will go towards the upside? Knowing that there's a war going on. Not the uncertainty whether it will escalate or not, that the Western powers will be pulled into this fight. The interest rate hikes, and as well as with this fighting going on, what impact it could have on inflation, what impact could it have on supply chain, right? So, and eventually, how will it impact the interest rate hikes, right? So, supply chain getting further affected by this fighting going on could lead to a further increase to inflation rates, which might push the federal government to increase interest rates sooner, possibly higher as well. And these are all uncertainties, and investors don't like uncertainties. So I was wondering then, what then encourage investors to invest, to buy last week? And remember one thing, investors are always looking for the next dip to buy. It's become a habit for investors to look for the next dip to buy. So what I am using now to get a better idea would be the relative strength indicator, RSI for short. And it's this tiny little graph over here where it ranges between 10 to 90, of course between 0 to 100, right? And it's an indicator to show investors, right, whether for example, in this case, this is measuring the RSI for the S&P 500, whether it's oversold or overbought. Now, so over here, the RSI was below 30, indicating an oversold. That the S&P 500 ETF is oversold, and to investors, they can use it as an indicator that it's time to buy the dip. And remember, this was during the Chinese New Year period for us. Not much we can do back then also. See what happens. The S&P 500 swung towards the upside, and then it hovered around, right? And what happened last week? The RSI went close to 30. It didn't go below 30. By the way, interestingly, it did not. Okay, so normally in a bullish market, what investors are looking out for to know when to exit, to sell, or to paper hand, is for the RSI to go above 70. It's basically indicating that the S&P 500 is overbought. So overbought it's basically too expensive to buy lah. So what then? Exit. But in this case, when we look at the way S&P 500 took a dip, it didn't even require the RSI to cross 70. All it needed to do was just hover at 50, RSI strength of 50, and investors couldn't hold already. So so there was selling, and before the RSI could cross below 30, man. So it's very interesting. So what we are having here is investors don't need to wait for the RSI to go below 30 for them to buy more, to buy the dip. Neither do they need to wait for the RSI to go above 70 to sell off, to take profit. So what does that mean to me at this point in time, right? It's that as the RSI start approaching towards 30, I will buy the dip. I am still holding 70% cash at the moment. You know, what was happening during the week before last week, I was just buying in slow and steady, 2%, 3% a day. And when it reached this point, I stopped just to, have a look whether it will go below 30, but it didn't. So I was quite surprised lah, that it could, have a slight rally. And yeah, for me, it's still going to be dollar cost averaging every time the RSI is going back down towards the 30-point mark. Of course, I'm still going to use trend lines, right? Like, for example, when the price of the S&P 500 goes below the lowest low, it could also be an indicator for me to start dollar cost averaging again. So let's also look at the triple Q, which is US large cap companies, and also mostly technology as well. So looking at the RSI, yep, right. So it went close to the 30-point mark for the RSI, and then we saw the swing towards the upside. What about Europe? So slight, but it couldn't sustain. So the RSI started falling. So the RSI falling doesn't necessarily reflect how much the price of the ETF falls, right? And also not forgetting that it is now below. Okay, just to recap a bit, this horizontal bar, the green and the red, it basically reflects the volume of the ETF being traded within that price range. And within the price range of 64 to 68, right, was where the highest volume of trading happened. And now it's way below that volume, that price range. So is it an indication that it's time to buy the dip? Yeah. Could it fall further? Also, yeah. So dollar cost average, like no doubt about it, right? Let's look at energy, because why not? Okay. So as you can see, right, when the RSI for the energy ETF cross energy, we're talking about oil, mostly oils. When the RSI crossed the 70 mark, right, we can see people starting to collect some profit. But energy is wait, what happened here? So this is 20th January. Oh, I didn't silence my phone. I've been sharing with my friends about my results. Okay, silenced. Right. So still holding strong, not going anywhere close to, it's possible that it can go back up towards the 70 point on the RSI, because the demand for energy is ever increasing, and because of the Russian-Ukraine war, and with the sanctions that's happening, right, supply can drop. When demand goes up, supply drops. What does that mean? Price go up. China, triple Q. So hovering, RSI hovering around the 35 to 50 range. So, you know, does that mean that China is going to, is that an indication of China bottoming out at, around pre-COVID levels? Well, possibly, except now the West is trying to pull China into sanctioning Russia. So, yeah, dollar cost average. How about Asia? Right? Strong, as in, sorry, as in bottoming out. Looks like bottoming out as well, right? Very close to the price range where the volume of trading happened, the highest volume of trading happened. So I'm also dollar cost averaging into Asia, excluding Japan. So yeah, looks like there's nothing much sustaining this rally, right? So I won't be counting on a bullish run for the market at the moment, and I will continue to dollar cost average when when the next low breaks when there's a new lower low, right? So dollar cost average, and if possible, raise as much cash as you can because there will be more discounts to come. Thank you so much for joining me on this live, and I can't wait to recover fully. And yeah, please come forward to, if you're having these conversations on your own, please come forward, join me in this conversation as well. It's actually quite lonely. And yeah, let's form a community together. Thank you so much. Take care. See you.